As investors look for signals on the Iran war, my next guest says the conflict is more of an inflation risk than a recession trigger. Sébastien Mc Mahon is Chief Strategist and Portfolio Manager at IA Global Asset Management and joins us now to talk some more about this. Sébastien, what's behind your confidence that the Iran conflict is unlikely to hurt growth?
Yeah, we've talked a few times this year already, Marilla, and I've been talking about our leading indicator, which is based on monetary policy and what central banks have done around the world. And it's been pointing towards a solid year in 2026. And the latest PMIs also followed suit. So that gives us a resilient macro backdrop. So we have, a few economic models that we ran. We ran a few shocks, the oil shocks through our models. And it would take a very significant shock, I would say, to bring the Canadian and the US and the global economy into recession. So we have no recession on our radar, even if we have a shock that is prolonged. Let's say you hit $130, in one quarter, and then you go back down to around $80 by the end of the year. Even that is not enough to bring a recession. So that still means risk on. That still means equities over fixed income. So it's in line with the strategy that we had since the beginning of the year.
Okay, so is there a price level for oil that would start to depress growth at home, and how sustained would it have to be?
It would need to be sustained. The actual price level is kind of tricky, but we think that it's more about how long it lasts. So let's say you have multiple quarters of above $100 on the price of oil, then that would lead to inflation that would be likely broad-based. So it's the inflation expectations that central banks will be looking at first. They can address that through forward guidance. But after that, if you have breadth in inflation, then that might force central banks to start hiking and remove liquidity from the markets, and then that could be enough to push markets a little bit lower. But still, we are close to correction levels on the TSX S&P 500 already, -7%, -8%. We are in correction level for EMs and EFI. We feel that most is already in the price. And from here, the cyclical trade still looks pretty good. Tech in the US looks good as well. So there's good reasons to be buyers.
Can you give me a bit more of an idea of how you are positioning right now with the spike in oil, but you don't think it will be sustained, is my understanding, and what you're doing in the interim period?
So sure. So we pretty much stayed the course. We were overweight equities, underweight fixed income at the beginning of the year. So we still think that's the way to go. If fixed income, is not going to be generating lots of returns this year. So maybe if you want income, dividend payers might be more interesting. We came into the year with a net long position on commodities through the BCOM index and through ETFs in some of our balanced funds. But we've taken some profits on that because, things have become exponential over the first quarter. So already took some profits there. But if you look purely at equities, the cyclical trade we still think is interesting. So overweight TSX, overweight EFI, overweight emerging markets versus the S&P 500. But within the US, focusing on growth, on tech, on AI, we still think that's the winning situation.
Okay. That being said, Cenovus is a stock that you do like today. Tell me about that.
Sure. So we have a target of about $40 in the 6 to 12 months range. So that's about plus 20%. Mostly, because of the recent acquisition of MEG Energy and the integration that's on the way. We think there's meaningful operational synergies here, and it's an excellent timing given the oil price surges. So boosting of free cash flow from higher oil prices. Management also is exploring asset sales to reduce debt further. We think at some point it could even be some share buybacks there. Canadian heavy oil differential also has shrunk a fair bit. Now it's about $12. That's a actual interesting tailwind for our cash flows. And valuations also remain attractive relative to peers. So we think that within the Canadian landscape, if there's one stock that sticks out and that makes a ton of sense, that would be Cenovus.
Okay. You also like ASML holding part of the AI supply chain, I guess, a chip supply chain. What do you like about it?
Yeah, exactly. So this is a company from the Netherlands, but you can trade in the US. Price is about $1,400. Now our target is $1,900 in 24 months, so plus 40% over 2 years. The news flow of 2026 has been very interesting so far, and we kind of forgot about the AI trade, but we're still bullish on chip makers. ASML is a key player, and we feel that the main constraint on AI right now is not memory. The main constraint is wafer capacity, and ASML machines are what you use to build those chips. So they are actually really purely at the choke point of this industry. So every incremental advanced chip, whether it's for AI accelerators, data centers, next generation processors, they must pass through ASML equipment. There's a combination of capacity scarcity, monopoly positioning, long dated visibility here makes ASML one of the cleanest ways to express the AI theme. So bottom line, ASML is key to the AI build out in a market where demand is structurally ahead of supply. So if you're still interested, you're still bullish chip makers, you still think that AI is going to be an important theme going forward, well, ASML is right at the center of that theme.
Okay. We appreciate you coming on the show today. Sébastien Mc Mahon is Chief Strategist, Portfolio Manager, IA Global Asset Management.